Great investors buy low and sell high, right? But how do you know when an investment is too high and it's time to sell? That's what you'll learn in this video. No one has a crystal ball, of course, but I am a chartered financial analyst and I've spent years working with some of the most successful investors in the world. So I'm going to show you the techniques I've learned that help me sell at the red S's and buy at the blue B's. For the average investor that just wants to buy and hold, set it, forget it, I'm fully on board with that. But for the investor that wants to try to do better than that, this video is for you. If I just bought and held since my first purchase in early 2020, I'd barely be breaking even right now. Instead, I've earned returns of 57%, 99%, 41%, and 64% in this 2x levered Brazil ETF. Here's how I did it. Sell timing is a combination of art and science. And to give yourself the best chance to get it right, you'll have to use both of them. Let's start with what you should start with, which is part of the art side. The first step toward getting the timing right is planning it out at the beginning. When you buy. Leveraged ETFs, like the ones that I like to buy, are rentals. That doesn't mean you should be day trading, but it means that you should have an exit plan from the beginning. Why are you buying? What do you think will happen? What do you see that the market doesn't see? Once the market sees it, that's usually a good time to sell. This is one of the most important investment lessons you could ever learn. The market price of every investment is based on what is currently expected to happen in the future. You do not want to wait until what you think will happen actually happens. You only want to wait until everyone else thinks it will happen. Most of the price move happens before that. Don't be greedy. If you're right, it's going to feel better and better the more an investment goes up. You will not want to sell it. That's where the science part comes in to help you, but we'll get to that in a minute. The other time that art comes in is when something else along the way changes your thesis. The key to getting this right is to look at everything that can impact your investment, not just the thing that drove your initial thesis. That probably sounds a little fuzzy right now, so let me give you a real-life example from the biggest investment mistake I've ever made. I loaded up on this 3x small cap ETF, TNA, in early 2020, right near the bottom. My thesis was simple. The world was going to go back to normal, and these companies were not all going to go bankrupt. I didn't know when it would go back to normal, but I was pretty confident that it would. So that's what I was looking for. By mid-2021, I was up about 3 to 4x my money in just over a year, and I was feeling great about it. And better yet, the world was definitely still not back to normal, so I thought there was a lot of room to run. I also found ways to justify it in my mind, like the fact that from the bottom in 2009 to its peak in 2018, TNA had rallied 35x. So up only 3 to 4x, it must still be in the early innings of the recovery, right? Don't be greedy. I failed to consider the thing that ended up coming out of left field and crushing TNA, which was rising interest rates and inflation. Small cap companies have to borrow more and at higher interest rates compared to large cap companies. It would have been an obvious sell signal if I just paid attention to it, but I had my blinders on, only focused on the original reason I bought it, the world getting back to normal. I also ignored the science part, which was flashing sell signals in front of my face. For the science part, I used the relative strength index. That's this little chart at the bottom. Generally, I hate technical analysis because it's been proven not to work, but this one helps keep me in check. Remember how I already said twice not to be greedy? Well, the exception is when Warren Buffett said, be greedy when others are fearful, and be fearful when others are greedy. The relative strength index helps me do that. We are all emotional. Understanding how those emotions impact your investment decisions can help you overcome them, which is why we just did a whole series on the psychology of money. But that's just for your own emotions. RSI can help you take advantage of other people's emotions. This may sound simple, but all stock price moves are just the result of the collective buying and selling of all investors. If more people are buying, a stock or ETF goes up. If more people are selling, it goes down. Simple as that. Most people are pretty bad investors. They get caught up in hype and headlines, they invest emotionally, and the timing sucks. If you do the opposite of what they're doing, your timing will usually be pretty good, just like Warren Buffett said. The RSI basically measures how extreme the stock or ETF's recent moves have been relative to its normal range. To add it to a Yahoo chart, you just go to the upper left and click on Indicators, and then select RSI. Then this box on the right will pop up. The standard way to set it is for it to look at a period of 14 days and to consider an RSI of over 70 to be overbought and an RSI of under 30 to be oversold. You can play around with different measures if you want, but that's how I have it set. Then I usually overlay this onto a 1-year price chart. So it compares how the recent moves in the last 14 days have been relative to the moves of the last year. Here's an ETF I bought last week, SVIX, an inverse VIX ETF. I'll have to do a separate video sometime explaining what this is, but the day I bought it, the RSI was at 17. Anything below 30 is a buy signal. Anything below 20 is a screaming buy signal. I'm up around 30% in 4 days since buying. It's the same thing on the sell side. Over 70 is a sell signal. Over 80 is a huge sell signal. But here's the kicker. This always has to be used in tandem with the art side. They work better together than either of them does on their own. For example, here, the market was selling off because it was worried about the Japanese carry trade and a US recession. I wasn't particularly worried about either of those things, so it was easy for me to marry the art side, I think the market is too fearful, with the science side, but RSI also thinks the market is extremely fearful. The harder part is when they don't easily match up. Let's go back to our chart on UBR, the 2X Brazil ETF, for an example. Generally, this process has worked really well with UBR because investors tend to go through phases where they get extremely high or extremely low on the Brazilian market, and the reality usually turns out not to be as good as hoped or as bad as feared. I also follow international markets really closely as a part of my day job, so I usually know what's getting people excited or scared, and I can judge whether I agree with it or not. There was one case, however, where I did agree. You can see how I sold on a big down day in early 2021. Normally, I don't do that. The RSI, the science side, was saying, everyone is too bearish, you should buy. And I was saying, yeah, but they're bearish for a good reason, and things could get a lot worse. When this happens, you have to make a judgment call. I decided to sell. And in this case, it turns out I was wrong. What I do most of the time when my instincts, the art side, and the RSI, the science side, disagree is add or trim part of my position. That's basically what I did here in 2023. I sold half of my position when the RSI told me to, but I was still pretty positive on Brazil. Then, when it kept going even higher, I thought, okay, maybe it's gone too far, and I sold the rest. I should have done this with TNA, but I didn't. Would I have been kicking myself after every time I sold and it kept going up? Yes. But my average selling price would have probably been in the $50 to $80 range. Instead, I mostly wrote it all the way down. This last point I'll leave you with is a very important one. Even though I was right, I still should have gone against my instincts and trimmed. This is a 3x levered small cap ETF. It's incredibly volatile. I felt like, this is just a technical indicator. It's just looking at the last year. It doesn't know that something very significant in the world really has changed. We got vaccines. The world is going back to normal. I was right, and it did keep going up. But eventually, something else derailed my investment later on. I didn't see it, and you won't always see it, even if you are looking. With leveraged ETFs, you just can't be greedy. There have been lots of times when I have gone against my instincts and trimmed when the RSI told me to, and I've been happy in the end almost every single time, even if I was mad about it for a while first. You can't go broke by selling at a profit. If you enjoyed this content, please hit those like and subscribe buttons and share it with someone that you know that likes to do their own investing. By the way, the ETF I bought that's up 30% in 4 days, I told our Discord I was buying it on the morning of August 5th. If you want to get notified on the next one, Click the link in the description to join our 100+ strong community of people just like you who want to become better investors. Thank you for watching, and I'll see you in the next video.